Our Singapore Central Bank is looking to cut the emissions intensity from its equities portfolio by up to half by 2030. Funds sold to retail investors will also have to back their claims of meeting environmental, social and governance or ESG standards. Melissa Goh has more from its second sustainability report.
Building a more climate-resilient and sustainable financial sector. And it could start with giving investors more clarity around a fund's ESG approach. Fund managers will have to disclose investment strategies, risks and selection criteria on an ongoing basis.
Investors will receive annual updates on how well the fund has achieved its ESG focus. The new guidelines to take effect from January 2023 will help to reduce greenwashing risks and enable retail investors to better understand the ESG funds that they invest in.
One analyst thinks fund managers will have to double down to meet these rising investor expectations.
If the selection criteria is just looking at some ESG ratings that is available in the market, it may not be sufficient enough for a regular monitoring. And another challenge will be the quality of ESG data nowadays is still in questions by some investors regarding their reliabilities and comparability as well.
Apart from improving sustainability disclosures, the central bank will green its portfolio. Equities and corporate bonds of some companies will be gradually excluded. These firms earn more than a tenth of their revenue from carbon-heavy thermal coal mining and oil sands activities.
Such companies have high transition risks, but limited long-term prospects as the world transits to the use of cleaner or renewable sources of energy. It's very carefully chosen, thermal coal mining and oil sands. High chance they will become stranded assets in future, which means they will have much less value. So I think there will be no sacrifice in returns.
The MAS is aiming to refine its equities portfolio by shifting towards less carbon-intensive exposures. Transition finance or providing companies with the funding support to go greener is a key theme of the MAS report. It says it's more important to green the economy than to grow the green economy, adding that Singapore needs to have strategies to progressively reduce the carbon footprint across all its sectors beyond just investing in pure green activities like renewable energy and green tech, which make up less than 8% of the economy. It's also stepping up efforts to cut its own emissions by promoting e-payments. Producing excess new notes to meet the festive demand makes up 8% of its carbon footprint. That's comparable to emissions from powering 430 four-room public flats a year. In fact, it says work around producing currencies was more than half of its total emissions last year. The central bank aims to pave a way towards a future where it will no longer issue new notes for festive gifting.